it certainly has been an interesting quarter. The S&P, the Dow, the NASDAQ, the TSX, Bitcoin, gold all hit all-time highs in the last 3 months. And recently, the TSX has started to outperform the U.S. markets as these moves in commodity prices, whether it's gold, whether it's oil, help to boost the overall index. Is this the start of meaningful outperformance? Let's bring in Darren Sissons, partner and portfolio manager at Campbell, Lee and Ross, joining us. Darren, thanks so much for being with me. When you think about what make up the components, the guts of the TSX, it is those financials, materials, and energy. Are you feeling like the energy material rally is a head fake, or do you think the beginning of something sustainable?
I think if you look at the trends of in the energy sector, I think for longer term investors, I think there is some upside ahead if you're prepared to buy at these levels. The easy money was obviously made in 2020, but having said that, we like energy here. We're constructive on energy. We think that there's an opportunity moving forward. And I think across a number of commodity sectors in general, we also think there's some value there as well. So given the TSX is commodity heavy, I would say that the outlook for the TSX looks reasonable relative to, say, for example, something such as the NASDAQ.
And how are you playing that? How is that manifesting in the portfolio?
How's it manifesting itself? I think at the moment, we're probably a little concerned about what happened last week with regards to rates. The market was mistakenly, in my humble opinion, expecting obviously guidance towards significant rate cuts. But the US is not in recession, labor markets aren't in trouble, and we're not seeing systemic pressure. So I thought that was a completely misnomer. And we're really waiting for guidance on that. The market initially took off with the expectation there were going to be significant rate cuts. But there is, if we didn't have an election year this year, I think there's a very good case that interest rates would actually be higher later in the year. Look at the Canadian economy. The print this year for GDP has actually been quite positive. So I think rate-sensitive stocks look interesting. I think we're going to be in a higher for longer environment. And I think that companies that have higher returns, higher multiples will be challenged in a rising, in a higher cost of capital environment. So I would say we're looking at opportunities where there are rate-sensitive opportunities. We're looking at opportunities where there are higher dividend yields, and we're probably staying pat or well, definitely not adding to our exposure in the higher growth segments.
Oh, that's interesting. Now, rate sensitivity can manifest in a couple of ways: cyclical, financials, banks, insurers, or more defensive, telecom, utility, real estate. Are you playing both sides of that, or are you preferring to be tilted one way?
I think we already have exposure. So we already have exposure to the banks. We have some insurance exposure. So we already have some exposure. So the question is, what are we doing around the margins? What are we looking at? And I think what we're doing now, in fact, what I'm spending most of my time on right now is looking at my wish list and deciding, am I going to get an appropriate opportunity? One name I would love to buy, but we're only going to be able to buy it in a recession because it's very highly priced. And then a couple of names, we're looking to see, is there an opportunity to upgrade and perhaps port holdings into a better opportunity? That's sort of where we're spending most of our time. So it's not specifically looking across the GIC codes and saying, what is the appropriate place to park capital? We're more sort of bottom focused and saying, okay, where do we want to add value and what names do we like at this point in the cycle? That's more how we're doing it.
What's an example of a wish list stock?
Well, one name I think has always been expensive is Hermes. I think that's a great company. But there are a number of different names that you can look at, companies that you'd like to own for a long period of time. Hermes is a great story, but it's very, very expensive stock. I'd love to own Hermes. At these levels, I wouldn't touch it.
What about Apple? There's a debate around that. It's pulled back, but some still say it's too expensive.
I think the issue is the forward growth outlook for Apple has slowed. You know, and I've said this for a long period of time. But if you look at some of the fundamental issues, you've got a slowing top line. You've got you obviously got growth in China is slowing significantly. There've been a number of announcements from the government in China to decrease the exposure of the Apple products. And then in a rising cost, in an inflationary environment where the cost of living is very expensive, are people going to want to justify a $2,000 phone or the upgrade cycle, or will they delay it? If they delay, that's going to weigh on earnings. So, look, I think Apple's a fabulous company, but I think you've got to look at a company and think, what is the difference between a good investment and a good company? And sometimes they're very different. So, but the biggest issue for Apple going down too much further is there are so many people that own it, and they've made so much money that they're not going to be ready and willing to sell the stock. If they're not ready and willing to sell it, the stock won't go down. You need more sellers than buyers for a stock to decline.
I want to circle back to your comment on rates. You mentioned you own the banks and the insurers already, but it sounds like you're preparing a portfolio for a higher for longer interest rate environment. And that makes me curious about a subset within the financials, the regional banks. Some have recovered. The index generally has not recovered from where it was a year ago at the collapse of Silicon Valley Bank. But that higher for longer environment maybe tells me that this is not a group that you want to buy on the dips?
So when you're looking at banks, you need to think through a few different things. So in the US, and I think this is one of the things that people confuse, is the majority of the US consumer, ex credit card there is largely being taxed using interest rates as a tax at very low interest rates. So mortgages, 30-year fixed at 2%. Outside the US and the Netherlands, most economies are largely variable rates. And so here in Canada, the consumer differential relative to the US is stark. So we don't see a lot of credit card or credit metrics declining in the US or deteriorating significantly. In fact, the US economy is actually doing quite well. So on balance, so if you look at that, is there opportunities for a higher interest rate, which is going to drive earnings for the banks? I think so in the US. We have to wait and see if there's going to be unemployment, if there's going to be an unemployment spike, and we also need to look and see, is there a deterioration in the underlying credit conditions? And in all cases, the answer is no. So I think regional banks look interesting, but if you look at even at some of the larger cap banks in the US, they've run significantly. So the question becomes, if we do get a recession in the US, and we will at some point, will those gains be recaptured, and will the banks fall to lower levels? I think that at this point, the argument is probably there's more upside in regional banks and in large cap banks than there is a negative headwind. So I would be favoring both regional banks and US banks. We do not own a regional bank, to be fair.